Welcome to Investors Guide. Thank you for tuning in. I know that it has been a fairly difficult couple of weeks for investors, for retail investors in particular. We've had our markets become extremely volatile, and we're starting to see impact of demonetization on our mutual fund portfolios. Over the next half hour, we're going to try and tell you how to navigate your investments in the post-demonetization era, and how all of this is going to change the way we invest our money. We'll also look at the Reliance Growth Fund, of which we're getting a lot of questions. And for first-time mutual fund investors, we'll tell you how to design a portfolio. Let me first bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us. Dhirendra has been holding our hands right through this demonetization drive. Dhirendra, it's starting to show on our mutual funds. Most category averages are down about 1.5%. In some cases, more than that if you're talking about mid-caps and small caps. Now, there are various views coming in from market experts, and I tend to take that with a pinch of salt because that is information going largely to day traders. But from a medium-term point of view, this sort of pain is not over. The volatility is not behind us. So we are not stopping at 1.5% down for the week, are we?
No, one is that, don't trust the experts, simply because, including me, because nobody knows. We don't have a precedence. And it is extremely hard to predict how it is going to affect in real financial terms and how it is going to affect us behaviorally. It is just not a mathematical exercise that this much of money was in circulation, this much of money will be restored. It will take 90 days to get back into the system, and everything will be, happily, nicely settled from thereafter, and government will be able to cancel this much of currency, liability comes down. It isn't that simple. This is one exercise in this country which affects every citizen. I don't think we have had, besides election, I don't think we have any national exercise which has affected every individual. That too financially. I think the only exercise which is affecting everybody financially. It will have a radical impact on the behavior of variety of people, whether they be business, people conducting small business, large business, individuals working in those businesses, people working for the government, people working in political parties, social activities. It is going to have a severe impact on the way people acquire and build assets. So the impact is so pervasive that it is very difficult to, estimate. But my belief, I would like to share, is that businesses, organized businesses will benefit. Government will benefit if this translates into a behavioral change for the better. Short term could be very devastating. The demand destruction that we have seen and has the impact to cause a recession of a kind. It can also drive a lot of people out of temporary jobs who were in such jobs which were not trustable enough or stable enough. So it's very difficult to estimate. A lot of procrastination will happen. Consumer spending will definitely slow down. So, and trying to articulate all this into earnings decline and how people behave, the kind of things that we have seen in the past, the kind of companies which were efficiently run, will they have, what kind of margin of error they have, can they, because we were banking on the growth, and the growth is definitely going to get impacted. And I also feel that this cycle may not turn around very quickly unless, of course, there are a lot of unknowns. What kind of things government does after this? Will they do, will interest rates come down dramatically? Will tax rates come down dramatically? Will there be an incentive to, drive up demand? Those are, we haven't seen much on that front. And I think we hope that the government is proactive on those fronts and they will be able to cause some difference.
Well, see, here's the question at this point. Obviously, if we look at the numbers now, from a 1 month, chart, on the 1 month chart of equity funds, large caps are down about 8%. Multi-caps are down 9%. Mid-caps are down 10.5%. Small caps are down 11.5%. So it's very possible, obviously, we're all losing money right now as far as the market is concerned. How long are we expecting this to continue? Do you expect it to be a 3-month impact, a 6-month impact? What is short term? What is medium term? And at what point do you expect the market to live down the impact of this demonetization?
Good companies will get better. Bad companies will turn worse. Expensive companies which you bought in the past will suffer more. And we have been, cautioning investors for last maybe 2.5 months that small caps look very vulnerable, they look very expensive, and they were still racing ahead. The dynamics was very unfavorable. But, I'm not very optimistic. I really don't want to hazard a guess, because there is something very unusual about your investments. We have a lot of money which was lying in the locker is finding its way into the bank for the first time. And suddenly investors, individuals will have money in their bank account, and even a small part of it finds its way into the market. We have seen that, the last lag of the small cap, when we were talking about a month back, or, 6 weeks back, or 2 months back, they looked expensive, but investors were still pouring money. If investors continue to pour money, and I think there has, investment situation, or, the mutual funds in particular, the way they have, become well on their way to be, more broadly accepted as a smart investment vehicle, which can optimize your return. If we have the cash flows to their advantage, if we see massive inflows, and I don't visualize, I don't see situation. Also, what has happened to real estate, there will be freezing of transaction, or people will postpone their decisions. So there will be a lot of money which can find its way into the market through funds, and that can drive up the stock prices and the underlying stocks and the mutual funds. That is something which we have to see how it pans out, but that is something which can't be ruled out.
If we also look at the numbers right now of mutual funds over 5 years and 10 years, the funds are still beating the Nifty and the Sensex. And you must remember, if equity multi-cap fund has given an average return of 10.8% every year over the last 10 years and 15% every year over the last 5 years. So the long-term track record is something we need to keep our eye on, really, in this market, as opposed to what's happening on the short term, which Dhirendra says there's no way of telling if it's going to take 3 months or it's going to take 6 months. But the truth is, if you're in the market for the next 10 years, you have to keep your eye on that price. Dhirendra, we have some very interesting questions to answer this week, which is why I want to get straight to them. Govind Rajan has written in. He says he's facing a lot of problems in terms of the shortage of cash and the non-availability of cash and the daily restriction that he's facing. But he says if it is all for a good, for a good cause, he's proud of it and he's proud to be part of it. But he wants to know if it's a good time to buy a home given the real estate prices. He's saying that right now the home that he's looking at, he's been offered for 40 lakh rupees. It's a second sale flat. And he tells us the registration value is only 15 lakh rupees. He wants to know how to pay the remaining amount that he's going to have to pay of 25 lakh rupees. And I think this is something that we were hoping would go away post-demonetization, the fact that people would have to do completely white deals. But according to Govind Rajan, he's still being asked for a certain amount of that money in cash. What is your recommendation to people still facing this problem in the real estate sector?
It is better for all investors, individuals planning to buy a home to wait for the new operating framework, because this 40 lakh rupees property for which you only pay 15 lakh rupee is going to cause a lot of anxiety. Of course, you will derive the comfort of owning a home, but it may not be worth it. Wait for 3-6 months. I think things will change. The composition will change, the percentage will change. And there are a lot of other investors, even the person who is taking the money, that his house will also be a legitimate one, just that one has been used to it and one has been recycling these assets in cash. That has been the operating framework. I think this is bound to change. And I don't think that, it will change overnight completely. But it is definitely going to change for the better. Somebody who is doing this kind of transaction, the cash component will reverse maybe. Maybe if you have to give 15 lakh rupees in cash and 25 by way of check, that's a big shift. Somewhere where you're providing 10%, it will completely disappear.
All right, so the advice you're getting right now is to wait for about 6 months before you make any of those real estate decisions. And of course, we'll have this entire market settle down. Prices will settle down a little bit more, especially if you're making a second sale. Push for a better deal. Insist that you will pay all of it by check and you will register your house for that entire amount. That is really, given the current scenario, the best way to do it. We also have a question from Prakash. Now, Prakash tells us he watches Investors Guide on a regular basis and follows all of the advice. Here's his observation, Dhirendra. He says, we've recommended on the show, shifting to a direct plan makes more sense because that 1% that you will save on commission compounded over 20-25 years adds up to a lot of money. He's saying when he was watching news coverage about demonetization and he realized people who don't pay tax have an advantage of 30% compounded, which they have saved on tax on their assets, compounded over several decades, is an amount that the average, taxpayer can never catch up with. He says he still feels at a disadvantage in spite of demonetization. He believes that he can never catch up to someone who is not paying tax. He says the government must think of other ways to curb black money and to curb the illegal movement of cash in the market. He wants to know what your thoughts are on the subject.
No, it's very clear that, with your 30% of your income being paid by way of taxes, you are able to sleep nicely as compared to all other people who are having sleepless nights. That's one. The other is flexibility and freedom. The residual 70%, you are at liberty to do whatever. Tomorrow you want to migrate to another country, move with your money. You want to buy any asset, you want to have a diversified portfolio. You can happily, confidently, and with your head held high. That's most important. You can do everything that you want to, as compared to a person who has not paid, is right now struggling to convert his money into denominations which are accepted and legitimate, trying to buy assets which are likely to get frozen in value for a long time. It is a huge compromise on liquidity, and then living in fear. So how good is that? So, that I think is more of a conceptual question. You make a choice in life, leading a legitimate, doing things legitimately or not doing it. I don't think you should be regretting being a nice citizen or a fair citizen at all. In fact, very soon, this whole move has actually brought everything on the forefront that you can be proud of and other people should be ashamed of. I think there was a reverse of that before this.
Now, we're going to take a quick break. We'll come back on the other side and we'll talk about the Reliance Growth Fund. Don't go anywhere. Welcome back to Watching Investors Guide. Thank you for staying with us. It's time for us to look at our product review, and this week we're looking at the Reliance Growth Fund. Avan will give you numbers and then we'll come back and talk about it.
Thanks, Faye. This week we take a look at the Reliance Growth Fund. This mid-cap fund has been an average performer over the long term. While its performance has been fairly good ever since it started, its performance has taken a hit over the last 5 years. The red line is the fund and the blue line is the benchmark. You'll see that until the year 2011, the fund has barely managed to perform better than its benchmark and category. In the year 2011, the fund was at its worst, underperforming its benchmark with a return of a negative 27%. A quick peer comparison shows that not only does the fund underperform its category in the last 1 year, but several peers have performed better than its fund in the rising chart. The fund's performance over the long term when compared to its peers has not been very good either. So is it time for you to invest in other mid-cap funds, or should you consider a different category altogether? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. The Reliance Growth Fund, and the reason why we're bringing it up is because we've got a few questions from unhappy, disgruntled investors who are still holding on to this fund, not really knowing what to do. It's down to 2 stars on value research. What would you recommend investors do? Is it time to move out?
No, I'm not very sure because, it's a mid-cap fund. It has struggled for a long time. 3 years back, it was unable to beat its benchmark even. And its initial first 10, 12 years was, outstanding. Its performance till 2008 was just too good for most investors to ignore. And since then, it has struggled. It's a very high-quality portfolio. It's a mid-cap portfolio. But compared to other funds, and it is a big fund, it has, about 54 stocks right now in its portfolio. And it's a portfolio of good stocks. But relative to others, I think it is constrained. It was also constrained by, the kind of money which was moving out of the fund for a long time. That was another, unfavorable dynamics of the fund. So look, all these things over the last 4 or 5 years translates into below average return among mid-cap fund and above average volatility. and this will only compound because not much has changed. In fact, the dynamics for the mid cap positions has only turned little unfavorable. So it is not a great fund to have.
It's not a great fund to have. And Dhirendra, for those people who are shifting out of this fund at this point, what are the options really? Would you recommend they stay in the small cap or the mid cap sector, or is it time to go multi-cap, given the fact that we're going to see volatility over the next couple of quarters at least?
I would say that, multi-cap is always the best way to go because those funds are not deprived of, exposure to all segments of the market. They can also tilt to, mid-caps as and when it is opportune. And coming times, we saw that, there was a big tilt to small and mid-caps. And there will always be a charm of small and mid-caps in a rising market. But we tend to forget the downside of that. And this fund is one such example. It that how it suffers when you have this, and when you lose the flexibility with a lot of small position, what happens to the portfolio, your maneuverability, the way the portfolio manager or the fund manager gets constrained. So for most investors trying to seek exposure into equity, multi-cap or the balanced fund for the first time investor is always the best way for you to have. And more so at this point, unless until you are a very, you are an investor seeking aggressive growth and you deliberately want to move into that, and you have the temperament and the discipline, it's undesirable. And I think most mutual fund investors tend to be of that kind only.
Dhirendra, finally, what's your rating of this fund? It's 2 stars on the website, but for the point of view of investors on Investors Guide, where would you rate it?
I would rate it today as a fairly average fund. Maybe based on looking at the portfolio, I'm in fact looking at it as it looks like a reasonably promising average fund, not so comforting recent history.
All right, remember, if you have any questions about this fund or the fund that you're holding in your portfolio, write to us. Our email ID is at the bottom of your screen. We're here to help you with whatever you may have as a question in your mind. Dhirendra, our next question is the true impact of demonetization. 30-year-old Sampath has written to us from Pune. He has never invested in mutual funds. He's been investing in chit funds so far. And he says that he's been given a decent interest rate up till now. He would like to now begin investing in mutual funds. He has a child he's expecting next year, so that's part of the plan to invest about 40 lakh rupees he wants to save for the next 10 years for his child's education. He also wants to buy a house in the next 3 years with a down payment of 15 lakh rupees. He wants to put aside 15 or 20,000 rupees per month. So he wants to know where he should start investing his money and how should he go about it. So the transition from chit funds to mutual funds is very welcome. And Sampath, we welcome you into the world of mutual funds. Dhirendra, what is the best way for Sampath to get started?
For Sampath, it's important to actually do it in 2 steps. One is to build his emergency fund in a debt fund. That will be accessible to him. Somebody coming from chit fund will find it very comforting. So maybe 5,000 rupee, or maybe initially for 6 months he just does his investment in debt fund, and he has his 1 lakh rupee, 2 lakh rupee handy in a debt fund, which will generate reasonable return. Also in recent future, it will also be rewarding. And maybe 6 months to 1 year from now, after he has built that 1.5 lakh rupee, whatever he is comfortable with, then start with a balanced fund. And then he should invest his 15,000 rupees in a balanced fund, have a 3 to 5 years time frame, not to look at it, and most of his goals, and then increase his contribution. As he should save as much as he can. And the charm of chit fund is different. That if you're a small businessman who is unable to take money out of your operations, then it's a revolving credit. It is actually not a savings vehicle because you virtually get your money back or a little bit of interest, but everybody gets to own the whole pot on a monthly basis. So you are committed to paying that contribution. So it's just enforcing the discipline. It's a revolving credit. So if you want to move into this legitimate form of investment, there is one more advantage I would like to list you. Don't be fearful of this. Only the money which you will put in your balance fund and it will accumulate for your holding of over 1 year, it will be completely tax-free. And I think that is something which has gone unnoticed. It is a very obvious, basic thing that happens with your investment. All investments which are over 65% invested in equity, gains for all investments held for over 1 year is completely tax-free. And so deriving all your return in a legitimate form without paying taxes is a great incentive, and I think it has not been acknowledged or understood by investors as much. And as more and more people put their money which was lying in the locker into their bank account, they should seriously consider this.
All right, so remember, start investing in mutual funds, start small, build your confidence. And the best part about equity mutual funds and balanced funds, like Dhirendra was pointing out, is that after 1 year, the returns and the entire fund is completely tax-free. You don't have to worry about paying tax, and all your returns are tax-free in a legitimate manner. Sunil Singh has written in, he wants to invest for the long term. He has these funds in his portfolio, Dhirendra: UTI, MNC, Franklin India Prima, Franklin Tax Shield, iPro Discovery. He wants to know if he should continue investing in these funds. Since there have been so many policy changes, what happens also now with gold ETFs? Obviously, the first question, let's focus on the fact that these are great funds, and the policy changes shouldn't have any impact, ideally, on the funds that he's investing in, if they're for the long term. The next question a lot of viewers are going to be asking us is about gold. We've seen a lot of analysts tell us that gold is going to come back into favor as the repository of value of choice for Indians now. What's your call on gold, Dhirendra?
I've been wrong once again, because I have always evaluated gold as objectively as an investment avenue which investors look at. And the kind of situation caused by, including demonetization, creating artificial demand, or what is happening globally, the disbelief in fiat currency of every country, that creates the demand for gold. So I don't know. But I would think that, investment still is either you lend your money to somebody or you own a business. And so equity and bonds remain the principal investment class, and then you have house and property, house that you live in, and a house and a property that you can rent out. These are the logical, my understanding of logical investment vehicle or asset that you own on which you optimize your return. Gold on that front, last 5-7 years, or the kind of turbulence, uncertainty that we have seen comes back on the forefront time and again. What has happened to gold has benefited you, and I've been wrong. But I would like you to start thinking like me. Over a long period of time, equity will prove to be the best performing asset class. What is happening now will cause a lot of anxiety and turbulence in the marketplace, but 2-3 years from now. But if we are going to see a very nice, serene market in which you will invest, you will not be able to make, you will not generate great deal of return. Only when you continue to invest in these turbulent, uncertain times that you generate great returns. I don't think great return is generated by when you invest when the market is doing very well. When the market is struggling, there is a great deal of uncertainty. When you invest, have your 2-3 things in place, that you are averaging your investment. You are not taking a big bet at one point. You are diversifying. You are not taking 1 or 2 things which goes wrong and you go haywire. If you're doing, and don't put the money which you need in the immediate future into such a market. If you have these 3 variables in place, I think one tends to generate substantially higher return when you invest in the times of anxiety.
So that's the big takeaway that we're having. First of all, remember, exit Reliance Growth, invest in multi-cap funds right now, given the market that we're going to see. Remember that all of the returns that come out of your equity funds and your balanced funds after 1 year are completely tax-free. We still stand by not investing in gold as a regular salaried long-term investor. Look at equity mutual funds instead for the long term. That's a wrap on Investors Guide. Dhirendra, I want to thank you for spending time with us this week and answering your questions. We do understand our viewers at home that it's going to be a confusing couple of weeks to come, which is why we're here and we're going to answer every question that you have. Thank you so much for watching.